So I think Q2 is definitely going to be a little bit more challenging than Q1 for a couple reasons. We do have earnings growth expectations coming in at negative 3.7%, and IT is actually one of the sectors expected to post double-digit declines. So the market's going to have to digest that, and we're probably not going to continue at this clip unless we have a positive catalyst come along.
Steve, how about you? What do you see going forward?
Yeah, I mean,
sort of said the same thing, right?
I believe Liz to be correct here. When you talk about the clip that we have increased from the December lows, it's a pretty aggressive pace to maintain, Tyler. So I don't think that we're going to do that. But the other side of it is that most people are in the same camp as Liz right now, and I have been, where you're looking at EPS going negative, you're looking at guidance not being great. So where do we go from there with the market? Has the market digested it enough to move forward? Maybe, but I'm a little hesitant to say put new money to work where we're at right now.
How does what you said, Liz, translate into what you do with your portfolio in that? Are you staying basically fully invested and rotating into more defensive sectors, or are you actually paring back on your equity allocation?
It's a good question, and we get it every day. So what's important right now is we're not telling people to really come out of the market. I don't think it's time to divest. But what you have to make sure of is that the ballast in your portfolio is more effective than maybe it was a year ago. And a lot of investors had that search for yield. They're still really overloaded in high yield bonds and even that leveraged loan market that's going to have equity-like risk, and that doesn't provide enough of a ballast. So we're looking at taking a little bit more duration risk even in traditional bonds, so you can do that in sovereigns because now we have central banks on hold really indefinitely, and making sure that you have some of that offsetting piece.
Steve, what does Lyft tell you about the appetite, the risk appetite in this market, and what that might mean for mega cap tech?
Yeah, I mean, there's a tremendous appetite for growth. And you got to remember, when you look at these IPO markets, if Lyft is the first one to get here, with the sell-side banks that are obviously bringing these deals forward, people want these deals again. So they're less likely to take that deal from a sell side, get their allocation, and then immediately dump it on the first day of trading or dump it in the first couple of days. They're going to want the Ubers. They're going to want the rest of the IPO market.
So you got to behave in order to get the next allocation.
Exactly. So they're forced sort of hold on to it. But when you look at some of these companies, I think, Melissa, the bigger question is they don't have profits. So what does that tell you about the appetite of the overall market? Where are they reaching for growth? And I'm not sure that's a great, healthy sign for the overall market.